Did the hard bit.
Yeah. No. I mean, they're talking.
You need to go back and get them. No.
And then Good morning, everyone. Thank you for attending this morning. This is the third IRLA briefing we've done at Monte Carlo. Obviously, we haven't done one for 3 years, but we're very pleased to be able to provide something for our members and the wider interested audience. Hopefully, you've helped yourself to teas and coffees at the back. There is a slide show, but it's not ours. That's coming for the next session. We just have a blank screen for you to look at, which I've tried to turn off, but it keeps coming back on, annoyingly. But I'd like to introduce the panel of very, very well-regarded legacy and wider insurance experts who probably don't need much introduction, but for the sake of it, from the far left, your right, Kevin Gill, partner at EY, David Nye, Chief Strategy Officer at Enstar Group, Linda Johnson, who's the Legacy Practice Leader at TigerRisk, for as long as they're known as TigerRisk.
For the next few months.
Victor Nelligan, Capital Advisor at Aon, and James Bracken, the CEO of Fortitude Re in Bermuda. So we have sort of prepared some topical questions, but obviously this is open forum and we'd like to get interaction with yourselves. We don't want to sit here and tell you what you think you might want to know. We'd like to know what you want to know, and then you can ask us, so we can't tell you what you want to know. So I'm going to kick off with a fairly generic question, and why are we seeing an increased appetite for legacy transactions? And I'm going to put it on the brokers first, so I think only fair ladies first, Linda, and then we all agree with what you say.
I love being the first person for that reason. The appetite for legacy has been increasing for a multitude of reasons. The most important is just general education and understanding. Legacy transactions are very effective transactions that are a win-win transaction between the buyer and the seller, and they provide capital relief and finality and just big value added on multiple fronts, including claims handling.
Nice and short, Linda. Lovely. Thank you.
We want to get to the real question.
Oh, I know.
Yeah, well, of course I'd agree with everything that Linda said. And I guess the bit that I had drilled down to, which I find really interesting, is that we've seen a lot more transactions where that claims handling might stay in some form.
Yep.
And I think that's driving a lot of interest in legacy, because then the reputational kind of question doesn't go completely away, but it goes a little bit away. And that, I think, helps a lot of senior management to think, yeah, okay, well, all the benefits are there, and we're reputation risk is low, so why not use this tool that's there?
Thank you. They're turning to obviously one of the acquirers, and fairly new, relatively new compared to some of the 30-year stalwarts on the table. But your perspective, James?
Yeah, I think that's right. I think the ability for primary insurers to seek capital relief is increasing. We certainly see a bunch of interest around longer duration liabilities, where people are looking to potentially free up that capital to redeploy into the more recent underwriting years of being of heightened interest. That typically means the clients want to stay with the primary insurer, and so the insured wants to keep handling those claims for the long term. And for companies like Fortitude, where we're a little bit more larger balance sheet, we're happy with long-dated risks. It fits pretty well with what we're trying to achieve.
Commentary from the end, David.
Yeah, I fully agree with everyone's comments as well. Look, I think the trend's here to stay. I think it's a secular trend. I think if you rewind and think about legacy in the past, it was those really difficult to reserve for problematic portfolios. Now it's just well-seasoned portfolios that are coming for capital reasons. And I think from a buyer's perspective, I agree with James, which is on claims handling, for example, a lot of times we can add value. So that's one where, you know, the pie and the value pie is just expanded, so it's good for everyone. But, you know, oftentimes, you know, it might not be the case where we're adding value, or there might be some specific sensitivities there, and that's absolutely fine too. So I think the legacy market has just become a much more flexible tool for you know, all insurers.
Yeah, certainly become more flexible in the products it's offering. But also, I think you've seen that demand and supply come together at the same time here. That the market, the legacy market full of capital, is able to then provide capital solutions to the live market and tailor its solutions accordingly. And obviously, the live market's buying into that to get the capital relief. So the two coming together.
Thank you, Kevin. And I think certainly, from my perspective, it was the advent of the last 2-3 years of COVID that seemed to kick off some of these capital-seeking efficient transactions, with the deals we saw coming through in 2020 as companies' balance sheets were hit hard with the collapse of investments, the desire of regulators to see even stronger balance sheets, and then the hardening rates and the rush to free up capital to support the hardening rates. So unfortunately, COVID was terrible, but I think it did provide some impetus for the live market to actually engage with legacy players in that regard. And one of those areas, obviously, Lloyd's, which has been particularly active. So I just wanted to throw that open. Again, I think the brokers, because you've seen a lot of activity in Lloyd's yourselves, is that a new trend that we're going to see with the capital efficiency and the repeat business, or is it just a one-off activity at the moment because of the climate?
I mean, I personally don't see it as a one-off. I mean, you can see that there's been a spurt because of, you know, a number of RITCs for back years for, I guess, syndicates that probably more in the trouble zone. So, you know, under scrutiny because of decile 10 and needing to do something. But, you know, there's still a lot of the bigger balance sheets in Lloyd's that haven't done nearly as many legacy transactions, and they're starting to think more about, you know, how to strategically either, you know, take out lines of business. Unfortunately, split RITC for, you know, things that are going through exchanging doesn't work yet. Maybe we'll get exchanging there someday. But, you know, in the meantime, there's, you know, line of business specific LPTs that can work really well. And so I guess, you know, for all those reasons, I think that there's still tons more to go. And as the Lloyd's market grows and writes more premium, then there's just going to be more legacy when you come 3 or 4 years down the line.
Thank you. So to clarify, on the split RITC, my understanding is you can split by year of account because that's within exchanging's capabilities, but
Yeah, but
the
not
real panacea would be to be able to split out classes of business and change
Exactly.
them, especially off the back of the decile 10 exercise, where there are huge portfolios of classes that are just going to get dragged into the later year because you can't extract them out.
Exactly. So if you want to surgically extract, I don't know, you know, your professional liability business across a number of years of account, then, you know, you can't do that in the split RITC right now. But that would be a great thing to be able to do if all that was run off.
And Linda, from your perspective, you're obviously in contact with a lot of the agencies. What's their driver?
Yeah, so I think really, again, it's the capital efficiency and understanding the Lloyd's capital model, and these covers are split RITCs, LPTs, are very Lloyd's effective and efficient. So I think that will continue. We have a number of new runoff counterparties in Lloyd's, so we do continue to have increased competition on the buyer side as well.
I was going to come to that actually and put James on the spot and say, any ambitions for Fortitude to get into the Lloyd's space?
I think Lloyd's is something that we'll continue to monitor, but no rushing need to enter that market. There's quite a lot of people there at the moment, so you'll see us sort of standing on the edges, monitoring it.
Mm-hmm. And David, obviously one of the longest standing RITC providers at Enstar, what are your perspectives of how the market is developing at Lloyd's?
I think it's in line with the rest of the market. I mean, it's been a busy market beyond Lloyd's as well. Lloyd's has been busy too, but I think all the industry trends, the recognition that legacy and runoff is, an efficient tool, a very, very good capital tool and risk tool, depending on what the objectives are. I think all of those continue, and Lloyd's isn't in my mind, going to be left behind in any way, because I think all the tools are there for Lloyd's as well.
And I guess that's a question for me, if I'm allowed to ask a
Oh,
question.
no. Well, it depends what it is.
But obviously we see the deals that we see, and we see ones where we've gotten an RFP to try and pitch and maybe lost it. But from an Enstar perspective, and seeing I guess all the deals, I mean, are you seeing a trend where Lloyd's transactions are coming alongside the just wider LPTs as well, so that you can try and do both at the same time for the same company, or are you seeing them more bifurcated, that someone's coming just for Lloyd's? Or
more bifurcated for now. I can see that, Victor, kind of going down the trend of a bigger company that has sort of both kind of hand in hand. We've seen some transactions where there's a multitude of portfolios in one block. There's a Lloyd's component, and sometimes it's actually more efficient to do the Lloyd's to Lloyd's piece separate from everything else. But I'd say probably only one or two from us so far that we've seen.
And any observations from the advisory space, other than the brokers trading all over your tail?
No, but I think it's good to see the market, like Lloyd's market, vibrant again, doing these transactions again. I think Lloyd's were quite good about opening the market up and increase the competition there for capital supply to take legacy deals. So I can see that continuing, but it will probably ebb and flow a bit with the Lloyd's market as it goes through its cycles.
If anyone wants a seat, there's some at the front here if you don't want to stand for the next 45 minutes. But okay, so any observations, questions from the audience at this time? Interactions, are you still too a bit shy, a bit early? No. So obviously one of the big drivers at the moment in the market seems to be the new capital. We're all aware of new capital coming in, either setting up new operations or replacing capital in existing operations, or just bolstering the position of existing legacy acquirers with bigger balance sheets. Just interested in how the panel sees that with regard to the benefit for the sellers, the general competition amongst the buyers, and if there is a danger of it becoming too competitive and a race to the bottom. So who wants to go first? Go on, Victor.
I guess my view is always that more competition is better, right? I guess I would be saying that as a broker. I want as much competition as possible, and I think all these things are really great tools that have helped that. So the award-winning Gibson Re, which I think you're alluding to. But you're not the only ones that have done sidecar. I think lots of others are thinking about it, and that's just a great way to supplement the balance sheets that are already there with probably a slightly cheaper source of capital that can help you to do bigger deals. And I think, I'm going off slightly on a tangent, but we're seeing a lot of there's a small deals, and then they just seem to be getting bigger, right? So you need to have that extra capital to be able to do those deals and use that expertise. And so from a broker's perspective, I think it's great, and I don't think it's a race to the bottom. I think it's just another tool to allow people who are already good at pricing this business to do bigger deals.
James, from your perspective.
I think, new capital entering the market through these different vehicles, really the key question for those guys is, what's the exit strategy? Because, deploying $500 million of capital, $1 billion for 5 years and looking for a multiple exit is something that lots of people, I think, are trying to do. But not many of them have reached that exit point about how they will technically cash out of the deal. I think people need to think about that question pretty hard.
Yeah.
What's the exit strategy for that PE capital provider?
And certainly with EIOPA's increasing oversight of that, and they are very aware in Europe as to the tail of liabilities that are being assumed, but the general length of duration for support by capital providers. Although we have seen, obviously historically, capital exiting and new capital coming in and taking its place, but it's a very fluctuating market, but hopefully it's now a lot more stable.
Yeah, I think the insurance industry for the last 100 and odd years, it's all about that sort of patient capital being deployed for the long haul in the business and being there for policyholders. And what people have to figure out is whether the capital that's being deployed is transient or if it's permanent, and where will it go in 5 years' time?
I mean, the comment I would add is, I think competition is good for each entity, right? Having good competitors makes your firm better. And I think, the capital side, absolutely James's comments are correct, what is going on the capital side. But with regard to the different entities that exist, not that long ago, there were 3 or 4 companies that you would go to for a legacy transaction. Now, there are a dozen, or then if you expand it to include some of the traditional reinsurers or rating agency or rated entities, you can get up to 30 counterparties. Having 30 counterparties means that there's an array of appetites, there is an array of objectives, and just having those different perspectives makes us all better.
Yeah, I mean, I would say that, from my perspective, very similar to, Victor and Linda's, I think it's a sign of a healthy market when there's new capital, right? Because they see the returns are there and people want to participate. So I think it's a great thing for the industry. It shows that things are healthy. To James' point, I think the key on whether it ultimately becomes very, very additive to the industry from a solution set standpoint is, how long does that capital stay? Because, when we think about success and when, our partners think about success, they think about it in 30 years' time when the last policy is run off. It's not when you sign the deal. So if the capital is transient and it's gone in 5 years, that becomes a problem, and it probably doesn't add a ton to the solution set ultimately, because people are thinking about their long-term runoff, and they want that to go smoothly.
Yeah. I think just to add to that, I think there's the regulators begin to look at this now, is how the capital is structured and where the alternatives may come in, go out, and what that means for the underlying entities rising the business. So I think they're beginning to scrutinise that a lot more. But I think the point Linda was making is an important one too, that I think the increase in capital coming in allows competition at various stages of size of deal. So there's competition for the small deals, there's competition for medium-sized deals now, and the competition for the big deals, and also the deals are getting bigger. We'd be quite pleased with a $100 million deal these days, and then we're talking about $500 million deals quite more frequently, but there's still players in the marketplace that want to write the $100 million deals, $10 million deals. So you've got competition all over the place now, which is good.
Okay, opening to the floor, any comments, observations on competition?
Yeah, Paul, just those comments you just made about capital and what do you see new capital coming to the market? Look into your crystal ball 5 years time. Do you see that trend continuing of new capital coming into the market, particularly PE capital? And how do you think the runoff market will look in 5 years' time? With the number of players, will there be more, less? What type of capital, new capital?
I mean, personally speaking, I think there will continue to be an influx of capital, but in 5 years' time, it'll look to see how well it has performed over the last 5 years. So we've seen, as I alluded earlier, capital pull out, new capital come in and replace it, and that will continue. But we have to show that the industry can continue to deliver the returns that capital expects to achieve, and therefore maintain that sort of discipline around the pricing. And certainly we've seen transactions in the last couple of years that have been rejected because of pricing. The seller hasn't gone through with them, and then lo and behold they announce a big reserve increase in the press. We have to be very cautious of that desire. What is the intent of the seller to dispose? But I think the capital will always be in demand. It's not correlated with a lot of the other investment plays within their portfolios. They can get a good diversification when supporting a legacy player that's active in a number of different markets and different classes. So I think that trend will continue. But if anyone has any other thoughts?
Yeah, I think the question is whether the whole sort of ecosystem of insurance industry, whether the trend to a capital light model where underwriting companies make profit for underwriting, and they decide that reserve risk is something they want to transfer to people who specialize in reserve risk. And so I could see, I'm not saying it will happen, I could see a world where something closer to a Lloyd's RITC model is employed by primary P&C writers to underwrite risk for 3 years, harvest the underwriting profit, and lay off reserve risk to specialists who play in longer dated assets, or liabilities and assets, and have the patience to hold reserves for 30, 40, 50 years. And that's their business model. It's not, their business model isn't to underwrite the next $10 million of premium with this client next week. So I think that's the real thing. I don't know which way it'll go in the next 5 years. Whether that will become a major part of the industry, or it'll remain pretty small and it's a surgical application that individual companies need.
James, just to add to that, I always thought that convergence of both legacy and live business gets akin to what we see in the banking sector, whereas the banks, the front house of banking, but actually most of the stuff is securitized to other parties here. And you can see the legacy market becoming that capital supplier for that reserve risk. The insurance just becomes the front engine, and probably 12 months of claims, then it goes.
That's right, and we see that. We're a big life player in the US, and a lot of US life companies are heading down that exact path. They also don't know where they will end up. How much capital do they really need to support their business, and how do they service their clients? But there's certainly a pretty big shift of capital within the industry between sort of like the runoff player and the live underwriter.
So on that basis, and we've alluded to RITC's repeat business, are we seeing a trend towards perhaps companies, insurers, reinsurers regularly engaging with the legacy sector to provide that backstop, say after 3-5 years of underwriting, they roll it up, they pass it on, recycle the capital? Is this the trend that we're going to see? And in itself attractive then to new capital?
As long as they can get the arbitrage between the price they can lay it off and then redeploy that capital for new business, as long as they can get that delta, then they'll do it, I think. Yeah.
I think it relies on that sort of more traditional partnership model where repeat business is defined as something that you do with partners that you trust, and it's not a transaction where it's one side is looking to win and it's a win-lose. We need win-win transactions where legacy players, primary insurers can coexist in a world where they each play to their strengths. And I hope that's something that happens in the industry. I think we're well placed to deliver it, and we'll see. We'll see. At the moment, I think there's a pretty meaningful need for capital redeployment in the P&C space, and the folks around this table are going to try and help them.
Is that something that you're seeing in the broking community as to a desire from counterparts to develop that long relationship?
Definitely a desire. It's in its infancy as far as execution. There are a number of hurdles as you think about what happens in a portfolio. So if you think of a concept of I'm going to do a rolling reserve cover where every 3-year block, I'm using that just for Lloyd's example, but it could be 5 years, but every 3 years I take my back years and I roll it into a counterparty. So that is definitely a permanent capital solution that would be very attractive to our customers. The execution is still difficult because if I took all of my reserves from 2005 to 2008, will those perform in a like manner to how my reserves, more fresh reserves of 2017 to 21? I mean, so that the blocks do perform differently. The underlying mix is different, and our counterparties, they change over time as well. As they take on additional transactions, their balance sheets are modified, evolve, and so it might not be the best partner for the next transaction. And so you want to have partners, but you also want to make sure that you preserve the efficiency of these transactions, which is capitalizing on the differences in the different organizations. So great on paper concept, rolling 3-year reserve cover, execution, not for the faint of heart.
Question. I'm new to this space, so I reserve the right to ask stupid questions. Have there been any deals where, I mean, from a decedent's perspective, if they're looking at capital management and they want to look at it on a holistic basis, have there been any hybrid deals where carriers or reinsurers have done a prospective and legacy deal in the same transaction?
I can answer that too.
Is
Go
that
ahead.
possible?
So the answer is yes, but the first time I did that was 30 years ago. So I think it was Monroe Guarantee in Indianapolis. We did combination reserve cover, so adverse development cover, and aggregate stop loss, same contract, same transaction. The accounting rules have changed dramatically since then, and you really need to bifurcate that from an accounting perspective. So conceptually, they make a lot of sense. Again, super difficult execution, because what the risk taker is doing for the old years is they know exactly which policies have been written, or they have high degree of certainty of what policies have been written. When you're looking at prospective, you are now underwriting a leadership team and their business, their ability to plan their go-forward business. So it's a really different set of underwriting. That, together with the accounting rules, which Kevin and Victor will get better than I will, it's super complicated, and there's a lot of offsetting going on. So it's possible, it's probably not optimal today. And again, we have a lot of different accounting regimes as well on a global basis, especially for this conference. So looking at what your drivers are for, what your accounting impacts are, your capital impacts, it changes. But I wouldn't anticipate a flood of those coming forth in the future.
Yeah, all I was going to say is that often it's just a lot for a management team to think about. So it's more, look, we need capital to write this business that we think is great. Let's just focus on that rather than trying to free up a little bit of capital from the back years of that same book. Usually they're focusing backwards when there's a huge saving in doing that rather than, So I'd say that's...
I mean, the sector has always been very innovative, so I imagine the next stage is to look at those sorts of structures that give a clear exit before the entry has even started for some of these. But we'll watch this space. So thank you for your question.
Maybe just add one thing that we've done, and we similar to what Linda and Victor say, we don't typically look to do prospective and retrospective in a bundled fashion, but we certainly do retrospective legacy underwriting on the reinsurance side. And what we have done, and we've done this probably 8 or 9 times, is we've made actual strategic equity investments in companies where we like the prospective business, we trust the management, we think there's alignment, and we want to participate alongside the benefit there. So it's capital, right? But it's capital in the form of equity capital as opposed to freeing up capital in the reinsurance sense. But that's how we at the Enstar side have played a little bit in that way.
Thank you. I just want to move on something Victor had mentioned earlier about how the change has come through with the claims handler not necessarily coming across to the acquirer. And obviously for a couple of decades the legacy sector has been about taking on seasoned portfolios, managing the claims, getting results out of that, where that claims handling had perhaps been put into a back room of the seller because it was no longer live business, live clients active or attractive to them. With the change, is that bringing new dynamics then to the perspective of the legacy acquirers not having I think I allude in one of the articles that I've been forced to write this week, that you've lost the third leg of the stool. You've got your actuarial reserving to try and get that right. You've got your investment play, try and predict and get that right. You can no longer extract from effective and proactive claims handling and very much reliant upon the seller.
So a little bit, but I guess I would, the one thing I'd say is that there's the mindset and the years of experience with doing things like commutation, the faster settlement, etc. I think all that knowledge, but done in the collaborative way. So helping, sitting on the monthly claims meetings, looking at large losses. I think there becomes a partnership where actually it's not the same as managing the book and getting squeezing as much out of it as you can, but it is still a value lever that you can pull in discussion with your cedent. And so I think that it's not completely lost, but it's definitely it's probably not as big of a value lever as it might have been in the past. And ultimately the reason that you can't really move the claims on these things is A, they might still be underwriting the book, so they need the people to do it, or B, that the tail on it, as opposed to the 25 or 30 years or who knows how long for an asbestos book, it could be 5 years, right? And so staffing up for a big portfolio to do that from a legacy acquirer, I mean, it's gonna cost too much ultimately.
And David, how do you at Enstar sort of get comfort, and I'll come to you in a minute, James, on how you then are comfortable that the seller is providing full focus on that claims handling when the dollars are no longer coming out of their pocket?
Yeah, so it's a super important point. Overall, what we really care about is alignment, right? And there can be alignment if we're handling it directly, but there can be alignment if we're not as well. And so whether that's structural alignment to say, well, on the reinsurance, there's a vertical slice of a retention, retained by the cedent, that could be one way of aligning. Oftentimes what we do as well is, the interactions have become very collaborative. So I think there's recognition on both sides that, we've got some good experience in, handling certain things, and we don't need to contractually dictate that it has to be done this way. But if we can consult, if we have oversight rights, if we have cooperation rights, that's been, a new thing probably in the last year and a half, 2 years, where we've done a lot of those. And we found that those have been very, very successful, and that we haven't needed to sort of go back to a contract and say, hey, look, we have the decision to make this because everyone's in the same boat, as long as they're financially aligned to want that right outcome. So that's how we've done it.
I just echo what David said. I think it was a good answer.
Short and sweet.
Yeah.
And anything, Lynn, from your perspective, from the clients that you're dealing with, there's obviously an attraction for them to maintain that claims handling. How important is that? Is that the deal breaker if there is that impasse between the buyer community and the seller?
Yeah, well, I think that the buyers and the sellers are both really smart. So if you're an insurance company and you're looking at a reserve cover, there are certain claims where you add the most value, and there are certain claims where the counterparty adds the most value. And a good education on that certainly gets everyone to the same conclusion. So if I think about asbestos claims, having a specialist firm handle your asbestos claims makes incredibly good sense. If I think about cyber claims and you're the cyber leader and you have all the cyber secret set of tricks, you should keep the claims. Both the buyer and the seller are smart, and they will naturally migrate to the correct location. So as you're contemplating a possible reserve cover or RITC or split RITC, Lloyd's has some rules about claims handling, so I shouldn't overstep there, but it will be a rational conclusion. You will see an economic savings, and certainly not a threat. And you should not avoid a reserve cover because you're concerned about a reputational impact, because every buyer of reserve cover that moves claims handling is very concerned about their reputation, and they continue to have a solid reputation, even if some claims are managed in collaboration with another party. So the claims, I think, gets almost a little bit too much of a negative sell. Back in the day, the accounting had a really negative sell, and it's just an education process to get past these and say, claims handling is something I need to learn more about. Collateral, I may need to learn more about. Accounting, need to learn more about. But none of them are like, the rule book says I can't do it because.
Well, I think that this all shows the evolution of the legacy industry, and I think a lot of the acquirers have actually set up TPAs themselves to administer business where they acquire something they've got used to managing TPAs and how they drive value from that too. If we think forward a bit, there's lots of business now being written through MGAs. Now, at some point in the future, some of that will be put into runoff. It will come to the market. We're going to have to get used to managing 25 MGAs across the country, across the globe, is part of the legacy solution set. So I think just part of the evolution.
So the next sort of point I want to pick up on is where we think, and this is probably mainly the brokers, the decision making sort of sits within the selling community. We see some very proactive organisations like Zurich, who have this centrally managed business sector that identify portfolios that perhaps should be assessed in more detail and then outwardly traded and disposed of. Other organisations seem to be really hit and miss, and whether it sits with the CRO or the CFO or head of underwriting, what's your perspective, and what does the live market perhaps, what are they missing by not focusing on that particular aspect of the business?
Yeah, I think it's which portfolio we're talking about matters. So if I'm doing 100% or 90% of all of my back years, that decision will be the C-suite. It will be your most senior executives making that decision. If you are the chief underwriting officer and you've decided to discontinue this segment, that segment can be managed with a reserve cover. The decision maker would then be the CEO, but also supported by the CFO and other executives. I think everyone should be looking at this when they're looking at their capital models and looking at what's my most cost-effective form of capital, and you'll see reserve covers are very capital model friendly and very cost-effective forms of capital. So you'd want to make sure that that team is involved, but your ceded reinsurance team should be involved. If in the past they were buying, quota shares in excess of loss, this is another supplement to that portfolio of reinsurance covers as well.
Aon's view.
It's hard to add to anything really. I mean, I guess that's, to Linda's point really, is that it needs to be a team. It can't just be one person that's doing this. And actually, even when we see it start with one person, ultimately you end up talking to 50 people within the organization, and lots of different people feeding into the decision making. So I guess I wish the seeded teams would take more hold of it and be more interested in driving them forward, because I think they can pull in all those bits. But ultimately, it's also pretty helpful when you got the CFO on board and want to drive something forward. Higher execution certainty for counterparties.
I mean, I would add, when people buy reserve covers, they're happy about it. The buyers and the sellers are both delighted. It's never like a quota share where someone is disappointed about, a point of ceding commission here or there. These transactions are big partnerships, and you negotiate them, and it works for both parties really well. Even 5 years later. So I haven't had a cover where everyone said, like, gosh, I wish I wouldn't have.
Any other observations on the?
Well, I think that on the upside,
where do you go to target to try and get your business
well,
going?
I think the actuaries have an important part around the capital stuff. So the actuaries are a big driver to this, because it's a capital calculation. They're good at that, and they're actually quite good at carving out the portfolios. Well, that will be good from a selling perspective and a buying perspective. So that carve out. And we tend to get involved with, can you then grab your arms around that data to support that? You've done the model up here, but how do you get the policy underneath that? So, but that's so the actuaries are a key part in that, whether they sit in the risk place or in the finance place. I think the other thing too, it's just generally a good thing that C-suite are talking about legacy transactions. It's a broader discussion now. It's just part of the toolkit from a capital point of view that everybody's aware of and talk about, which is good.
I mean, my take is it's about whether these transactions are strategic for the company or transactional, and where it's strategic because investors are putting pressure on boards to improve performance, and they're trying to figure out what levers they have to play. And one of them clearly is to enter into a legacy transaction, and if that's how the board decides to tackle it, then that's where the decision making sits, because it's going to move the lever for that C-suite of people engaged in the business. So, yeah, I think it's again, shifting the focus of legacy from transactional to strategic solutions is really what will really make the difference, I think, for our industry.
So, any more questions or observations from the audience? We're going to run out of questions up here. Tom.
I think I see in Europe, capital relief is a kind of less frequent motivation for these transactions. So I think it is sort of market specific, some of the motivations. And I just wonder whether in the US, what the panel's view is, because I think often it's cited as the motivation. I'm not quite sure it always is. And even in Lloyd's, where I think, there definitely is more than often than not the capital motivation, then they're still picking a portfolio that they're concerned about, because of potential development. And so there's a lot of adverse selection, I think, where the market's got to be concerned of. I just think perhaps, I just feel maybe it's been a bit of an overplay on the sort of capital relief motivation. I was interested in the panel's view, and I certainly have an element of cynicism in the US as to that as being the sort of key motivation, albeit I understand sometimes we're talking about fairly small portfolios as part of the whole. I struggle to see whether that really is the motivation. It's not Christian.
Shall I answer that by plugging the IRLA book, Paul?
Yes.
If you let everyone look at the IRLA handbook, there's seller's motivation for getting rid of business, and beyond the capital stuff, those basics of that distraction, Tom, about we don't have the management for this anymore, the claim staff have left now, we just can't deal with this, they want to get off. And also we quite hear that volatility bit as well. They just want to get the numbers out of the way and crystallise some performance numbers. So I think the old fashioned motivations are still there, so it's not necessarily capital, all the motivations are in play still. But I think we've certainly seen from more London side that the capital one is the one that's been at the forefront at the moment.
Yeah, well, I think just generally, the impact of Solvency II across Europe is far greater than the solvency requirements in the US. And I mean, one of the other questions is about the appetite for transacting, and there is a feel in certain quarters that social inflation, which is a big buzzword at the moment, and the impact on the more recent soft years of US casualty, is that the real motivator behind some of this. And participants or sellers looking at what is a very buoyant and active market and thinking, I might be able to shift some of this before it blows up. I'm not sure whether.
Sorry, the motivation typically would be multifaceted. There's no one answer.
Yeah.
Many benefits. Typically, you need to prove more than one benefit to actually get them to agree to actually transact. So that's
Guy Carpenter's feeling left out.
Sorry, we didn't ask you on the panel.
The risk of being a little bit provocative on this point of capital relief. Do the markets in the room, do you worry at all about the cost of your capital, and in trying to make a competitive capital relief transaction? If you're looking for a 15% IRR and you're selling, the seller is trying to get capital relief, they might look at 15% capital as being quite expensive. Now, the capital regime is completely different, and you can have diversification go in different directions. But oftentimes, I get to Ronnie's point, we struggle sometimes to sort of explain the value if everybody's looking for 15% IRR. So it's a question.
there probably needs to be another motivation.
All right, I'm going to start with Tom's question. I think that the capital benefit is absolutely an area of, is it really creating that? And so what the brokers are doing is they are absolutely in the Bakar model. And so I think from an underwriter's perspective, a risk taker's perspective, talk to your broker and have them show you the Bakar model so that you can see the reserve charges in there and you can see the before and after analysis that we do. Because our goal is to make sure it's really transparent. So we're in it for the long term. We need to make sure that we have a very transparent relationship. With regard to the IRR, the complicator there is, what is the capital requirement? And the capital requirement today, what capital tool are we using? Is it before diversification or after diversification? Is it my first deal, which is going to be an infinite amount of capital or a very high amount of capital? Or is it my 50th deal, which will have a very low marginal capital if it's all diversified? So we use these tools like IRR, and we use these things like capital required, and these are really squishy numbers, right? Like, what is the capital required for any given transaction? It will change in 6 months. And so when we do these modeling, I think that we should make sure we're doing a lot of sensitivity analysis and realize that as the life progresses, all of the assumptions change.
I think the question on return hurdles is a really good one. I think it depends on the relative competitive positioning of the two parties to the transaction. Is one more capital advantaged based on the jurisdiction? Are they more tax advantaged? Do they have advantaged access to appropriate assets to back the reserves? Are their expense ratios comparable? So I think you need to go down a pretty long list of how both parties line up, and is the counterparty you're looking to transact with, what real value do they bring to the deal? I mean, it has to be something more than I've got $500 million of capital and, hey, give me this business and it'll all be great. It has to be more than that. So you've got to do that detailed calculation. You've got to, the capital one is a pretty major one to ensure that you've got cross-border arbitrage figured out. But it can work.
I mean, when you've got limited claims control, I guess really the question has to be a sort of difference in asset strategy. That's really Ed's question.
That's right.
Is,
That's usually the biggest lever, yeah.
What is, other than sort of whether it's sort of tax or capital advantages,
Yep.
which is possible, but some of these groups are pretty well diversified themselves.
That's
So
right.
I think we can't get away from the fact that on certain topics it has to be assets.
That's right.
I think there's also the challenge in the US, and I don't know if it's across all states, but certainly quite a few states where you don't even get the capital recognition of doing a retrospective reinsurance. So that comes down to different motivators potentially at play, because having laid off the risk, if you're not going to get the recognition in your RBC for that, then there is it's a nil game, really. But I agree with your point, Ronnie. There are multiple incentives. I think the challenge, whilst the broker may know what those are, it's not always transparent to the buyer what is the real desire. Probably for obvious reasons in certain scenarios.
Price doesn't always win as well.
Yeah.
It shows there needs to be more motivation.
Any other comments on those two observations or questions?
Well, Ed, I'd say just on the returns, maybe two things. One is, I think it starts with value. So are you adding value in any way? Because if you're not, then it's back to a zero-sum game, right? They're 15% is your 15%, and so it's just swapping. But if you're adding value on claims, if you're adding value on capital, if there's a tax advantage, if you're capitalizing it differently, if you're investing it differently, there could be something there. So that's one. Two is, I think on the returns, we've been doing a lot of thinking on our end on this as well, and it's one thing to say, look, I need to have a 15% IRR. But the real bogey is what's the spread over your cost of capital, right? Because if you had a 15% IRR but you have 70% cost of capital, that's not a good deal. If you had 15% IRR and you had 8% cost of capital, well, you're making that spread now. And so one of the other equations that we've been thinking a lot on, and goes back to the capital point, is how do we actually become more efficient on our end, on the reinsurers end, on the capital side? Because if we can lower our cost of capital, that means there's more value to be played. Like that Venn diagram just overlaps a little bit better and a little bit more. So I think that's how we've been thinking about that piece.
Okay. Conscious that we're running towards the end of the schedule, I know that the organisers will want us out 9:30 prompt. Any closing comments, please?
I'd like to know about the IRR, what you're saying about. What is your view on India? In this particular sector, what you are,
Well,
you must have made some sort of a survey of country-wise,
Yeah, so I think that there is reserve risk, and there's multiple layers of risk. So there's reserve risk, so let's start with, the reserves. There's claims and collections. There's different practices and different, formal or informal kind of practices that go to it. And then there's kind of broader country risk. I don't personally have a view one way or the other. I don't think we've done a lot in India ourselves, but emerging markets and emerging risk is something that we have a lot of appetite for and always look at. But I don't have a great answer for you personally right now.
I don't know if either of the brokers want to pick up where India sits in this.
I was going to say, I'm not sure there's been in India a reserve transaction. Maybe one of the UK branches might have done something. I'm trying to remember off the top of my head, but I think emerging markets is absolutely a place, where the market needs to provide the service, but it's probably not there right now in the same form as it is in the US and Europe.
some of the old, I think New India Re rings about some of these
Yeah.
old sort of offshoots
I
that
thought one of them
played in the London market, reinsurance
Exactly, yeah.
market, and got their fingers burnt, like so many of us 30 years ago. Well, I'm not going to end on that note. So, coming to a close, I'd like to thank James and Victor, Linda, David and Kevin. Just a plug for IRLA, the association. Obviously a lot of this discussion has been about the transactional side, but the association really is there for all angles of legacy, whether you have a very effective in-house management of your own runoff, whether you want to learn more about it. Our sort of educational and networking platforms are very informative in that regard. There is a handbook that Kevin alluded to, which has just been updated very recently with commentary on various aspects of the legacy sector from leading participants in the sector. So that's available. Our website, IRLA-international.com, will give you that information. And just to let you know, we are looking at possibly expanding into a sort of a Bermuda chapter. The BMA has become more focused on runoff, probably because it's most of the runoff acquirers have their headquarters there, and there will be tens of billions of dollars sitting in those entities. So the BMA become a bit more focused. The market feels as though it perhaps needs a voice. One of the things we do with IRLA in the UK is have a very effective lobbying process with the regulators, with government where necessary, and law changes to represent the voice of the industry without it being individually represented. So the community can come together with an anonymous voice, as it were, going back. So that's something that we are looking at to develop in Bermuda. There's a lot of interest there. So I'll just throw that out there, because obviously if parties here want to participate and work with us on that, I'd be delighted to discuss that. But we really see the growth of the industry over the last 30 years, and IRLA has played a key part of that, and I hope that continues, and we welcome more members into the association. And a final plug, Congress next May in Brighton. If you haven't already booked to get in the Grand, you're out of luck, because that's sold out. So we're now just taking bookings for attendance and then find your own accommodation, which worked very well last year, but it's amazing, and thank you all for your support for the association. We go from strength to strength, and thank you for coming this morning, and thank the panel.
Hey Paul, I've got some thoughts on your Bermuda thing.
I know, I can't remember, one of your colleagues was on a call, James Ferris, who was at PwC, arranged back in April. One of your colleagues was on, we were talking about it.
Yeah, so